Good morning, good afternoon, good evening, irrespective of where you are in the world. We're welcome to the financial statement series at the Peterson Institute for International Economics. And I'm Nicolas Véron, Senior Fellow at the Peterson Institute. And today we'll talk about bank resolution. We've devoted several episodes of this series this year to resolution and deposit insurance in the United States, following what happened in March with Silicon Valley Bank and Signature Bank and a few others. Today we'll look at the European Union and more particularly the Eurozone, where a new resolution framework has been put in place not so long ago and is already in the course of being reformed. So we'll talk about all that, and there can be no better people to talk about it than Dominique Laboureix and Kathryn Judge. Dominique Laboureix has been the chair of the Single Resolution Board. We'll come back to what that is. In Brussels since the beginning of this year. He studied at Sciences Po in Paris and got a master's in commercial law at University of Paris II in 1986. And then he soon started a career at the Central Bank of France, the Banque de France, initially in the payments department, and then from 1993 at the supervisory unit, which is kind of hosted by the Banque de France, semi-autonomous, initially known as the Banking Commission, later the Prudential Supervisory Authority, and in the latest years, the Prudential Supervisory and Resolution Authority, known by the French acronym of ACPR. So Dominique worked there until 2015 when he joined the Single Resolution Board, which was just in the process of being created in Brussels as part of the package of reforms known as Banking Union, so elevation to the European level of a number of instruments of banking sector policy, including supervision at the European Central Bank. We've talked about that in the past, but also resolution in this new agency of the European Union created for that purpose called the Single Resolution Board. And Dominique was a member of that board from 2015 to 2020. He, of course, had many international duties in that capacity. For example, he was chairing for most of that time the Resolution Committee of the European Banking Authority, yet another complicated body in the complicated EU setup. Then he went back to Paris to be the head, nominally the Secretary General of the ACPR, the Supervisory and Resolution Authority in France, and then again crossed the boundary between France and Belgium and came back to Brussels, as I said earlier this year, to become the chair of the SRB. So I think Dominique's career not only makes him the best qualified person to talk about the topic today, but also for me, interestingly, illustrates this increasingly frequent feature of officials in this kind of areas in Europe, where there's a back and forth between national and European duties, which I think Dominique embodies as well as probably anybody else. Kathryn Judge is the Harvey Goldschmid Professor of Law at Columbia University. She studied at Wesleyan University and then at Stanford Law School, where she got a doctorate of law in 2004. She was a clerk for Judge Richard Posner, very famous American judge, and Justice Stephen Breyer at the Supreme Court. She then went into private practice at Latham & Watkins and joined the faculty at Columbia University Law School in 2009, initially as a fellow at the Center for Law and Economics, and then as a law professor since 2011. I should also mention that Kate is now Vice Dean for Intellectual Life at Columbia Law School. She has published extensively on a number of legal and economic issues, and at the intersection between the two, she's got a book titled Direct on economic intermediation, subtitled The Rise of the Middleman Economy, that was published, I think, a year or two ago, and particularly has worked a lot on financial intermediation, which will be our focus today, including resolution. With that, Dominique, over to you.
Many thanks, Nicolas. Good morning, good afternoon, and good evening to all of you. Thank you for this invitation. I'm very glad to be with you today and to discuss this topic, which is called What Works and What Doesn't Work in the EU Bank Resolution Framework. Obviously, all the terms are important, but let me start perhaps by explaining a little bit what we call the framework, because generally speaking, we have two different elements here, and I would like to clarify them ex ante before going to the question itself. We have the regulatory framework for resolution, which was built via directives and regulations. In our jargon, for those who know it, BRD1, BRD2, essentially, as of 2014. So
sorry for interrupting, Dominique, but BRRD is a Bank Recovery and Resolution Directive of the European Union, correct?
Indeed. Even if you don't understand the acronym, it does not matter. It's about resolution, indeed, and crisis management of banks. So what is important is to note that it's a very recent legislation, which was adopted in 2014 and which was implemented in 2015 into the European Union, made of the 27 member states, and at that time even 28 with the UK. And there is something else, which is the institutional framework, which is called the Banking Union, with this decision of creating two pillars for the moment, one for supervision, which is headed by the ECB in Frankfurt, and one which is about resolution again, this time headed by a single resolution board, which is headquartered in Brussels, and I'm lucky enough to chair. So here on the Banking Union side, we have 20 member states plus Bulgaria. So the members of the euro area plus one who wants to join the euro area. And it's open to others, obviously, if they wish. The other members of the European Union, I mean. So this is important to keep this in mind, because when we are discussing these topics, from time to time, people are speaking about the banking union, so the institutional framework, and others are speaking about the resolution framework itself with the tools, etc., etc. All in all, 10 years ago, there was nothing. There was no legislation in Europe about resolution, about resolving banks, and there was no authority in charge of implementing resolution. So this is entirely new, and this means a lot compared to the FDIC in the US, created 90 years ago, or compared to the supervisory side, which was built through time. And as you said, I'm a living example of being a supervisor in the past years and developing the implementation of a framework which was built through time. So the story is largely different. Coming to the question, does it work or doesn't it doesn't work? Well, I won't answer yes, it works, or no, it doesn't. Let me try to start from another angle. Instead of referring to an ideal model, let me start from two perspectives. One, the recent market turmoil, the beginning of this year, and two, indeed, you have mentioned it, the new legislative initiative taken by the Commission, which is supposed to improve the framework we have. So if we say that we want to improve the framework, it means that we can do better. So let me go in a second step on this one. Let me start by the market turmoil by drawing some lessons from the European perspective, from the decisions taken by the Swiss authorities and the US ones. It's not my role, obviously, to judge what they have done. What is of interest for me is to take the European perspective, obviously, from these examples. Let me nevertheless mention that in both cases, financial stability was preserved at the end, and it should be noted, because this is one of the goals of any resolution framework, to preserve financial stability. The other one in Europe in particular is with no taxpayer money. So let's discuss this one also. Let me draw very briefly some elements on which we will come back later, perhaps during the conversation we'll have. One, obviously, we've seen the resilience of the European banking sector and more particularly of the banking union sector. We can ask ourselves why such a resilience, but let's consider that for the moment. Let's take note of it. We've seen also other elements, the speed of outflows. And the lesson for me here is clearly, once confidence is lost, everything can collapse and quickly. And so that means a lot. And for me, in terms of lessons for the future, I see essentially four things. One, we need to be predictable enough to be understood, but at the same time, we need to be nimble enough to be able to tackle the crises, whatever they are. And there is a tension here between predictability and flexibility. And there are several ways of addressing this one. Clarity ex ante, and this is my second topic, communication ex ante at the moment of a crisis and after the crisis is key to be understood again, and to be, again, predictable in the sense that people can understand what we've done, what we are doing, what we will do. That doesn't mean that we will commit to do exactly what we are supposed to do here and there, based on the resolution plans, for instance, because it depends on the features of the crisis. But communication is certainly my second topic. My third one is cooperation. When we go to cross-border banks, but when we go also to banks with cross-border operations and interconnection, we need to have a strong cooperation, not only between the resolution authorities, but also between the other authorities connected with other segments of the financial markets. I mean, securities authorities, but also, obviously, to some extent, central banks, governments, etc., as we've seen in the Swiss and American cases. My fourth lesson is about the strategies for resolution. So perhaps you know that when we implement a resolution decision, we built from a strategy. The strategy is based on a tool which can be, generally speaking, the bail-in tool for the biggest banks. What we've seen in the recent crisis cases is that never ever the bail-in tool was used. It doesn't mean that it was not usable, but it means that we must consider a crisis situation where the use of this open-bank bail-in strategy will not necessarily provide for the solution. I mean, if there is a liquidity crisis, to bail-in instruments will provide more solvency, but not necessarily enough liquidity. So we need to find other instruments. And certainly, the combination of tools, bail-in plus, is certainly a way forward for our future decisions. Finally, and this is a transition to my second step, what we've seen in particular in the US case is that a so-called regional bank can be systemic. We can discuss longly about the definition of what is a regional bank. But in any case, let's say a bank below the thresholds can become systemic at the moment of its failure. And this is exactly what CMDI tries to address. So CMDI for crisis management and deposit insurance proposal. So this proposal was made by the Commission, the European Commission, and now it's in the making process between Commission, the European Parliament, and the European Council, which is made of governments of the member states of Europe, of the European Union. So the aim of this proposal is to expand the scope of resolution to regionally systemic banks. And for doing that, the other part of the proposal is to, let's say, give resources coming from the deposit guarantee schemes. So to some extent, for those coming from the US, there is nothing extraordinarily new here, using potentially sources of funding coming from the FDIC for exiting these banks by using tools like sale of business or bridge bank for selling it later. So this is not entirely new around the globe. This is not entirely new within the banking union and the European Union, but what is new is the expansion of this scope. And to be sure that we can find enough funding, the proposal makes a series of changes, including the removal of the super priority of the deposit guarantee schemes in liquidation, because as you know, we have to compare all the time liquidation versus resolution, and to show that resolution brings a better outcome than liquidation. So this is
Sorry to interrupt, but just for clarification, what you refer to is that instead of being super senior, the insured deposit, the covered deposits in the European jargon, would rank pari passu with other deposits, including uninsured deposits, so general depositor preference, right?
Yeah, the changes which are proposed by the Commission are exactly along these lines. That's to say, instead of giving a super preference to only the covered deposits, they would give a preference to all deposits, covered or not. So within the waterfall, the senior class would be split into two different layers. One, the deposits, the rest as a senior class. So the senior class will be juniorized compared to deposits, but all deposits, you're right. So this raises controversy because it's not always understood. From our point of view, what we say is that it's not bad to give a broader scope to resolution, but indeed at the condition that we find sufficient funding. If we don't find funding, no need to expand the scope, because we will promise things we cannot implement smoothly at the moment of the resolution decision. There are plenty of other things. I don't want to spend too much time today, but there are other elements which are covered by CMDI. And all in all, in a nutshell, the ECB, Central Bank, European Central Bank, in its function of a supervisor, and the SRB as the resolution authority both of us are supportive, entirely supportive of this proposal. So let's hope that it will be adopted soon, and rather sooner than later, because indeed it could provide for some improvements of our framework. Where are we? Coming back to the questions, does it work or not? Where are we? Let me go on the legal side, the framework first. I will just mention some elements for the debate. There are things outside of the framework which are not tackled at all and which should be tackled because they influence the framework. I mean, harmonization of insolvency laws first, and second, more regulation for the NBFI sector, which is interconnected with the banking sector. So these are two elements which should be...
Sorry to interrupt again, but I assume you mean non-bank financial institutions.
Sorry. Non-banking financial institutions, indeed. We've seen a high amount of interconnection between the non-regulated or less regulated institutions and the banking sector. No need to have a perfect regulated banking sector if all the others are not sufficiently regulated. And when I mean regulated, I mean essentially transparent enough and with sufficient liquidity regulation about their own liquidity. Within the framework, I see two elements we can discuss. In the EU framework, we haven't found yet a solution for tackling the question of liquidity and resolution. In all cases, we have found solutions for the majority of cases of European banks, the smallest ones. That's true that for the biggest ones, the GSIBs, there is something still missing in the European environment. My second point is this question of systemic risk exception. We do not have it in the European framework for the moment. There are pros, there are cons. Personally, I'm not sure that we are missing this systemic risk exception. But as it was mentioned, in particular during the decisions taken by the FDIC and the other US authorities, I thought it was necessary to come back to it. And one thing I'm sure of, is that it's not a good idea to, let's say in Europe at minimum, to mention any systemic risk exception for covering all the deposits. I don't think this is something we need in Europe, and I will explain later, if you wish, why. Coming to the institutional framework, I said that several times here, there is no change in our position. We need more banking union than less. I think it's good to finish the banking union by building the third pillar of the banking union. Sorry for this jargon. The third pillar after supervision and resolution is a common deposit insurance scheme throughout the 21 countries members of the banking union. This is missing and this is needed. Finally, let me finish by something which is extremely well known. Looking at let's say the speed of the crises we've met in the US and in Switzerland, that's true that the decision-making process in Europe is complex and can be lengthy, and everything which can ease, smooth, simplify this decision-making process will be welcome in the European context. Let me finish by one or two words about one thing which is important to note, is that the framework can be perfect, but if it's not implemented well, it doesn't work. So we need to test. So this is exactly what we want to develop now. We have built this, let's say, the stones of the wall with loss absorbing capacity, with the requirements in terms of being ready, mentioning also the contributions to the Single Resolution Fund. Now we need to be ready to use these tools. For this, we need to test, to organize dry runs, to organize stress tests with banks, with the national resolution authorities, and with us, obviously, participating to these exercises. With that, let me conclude. I think the answer to this question is very, very simple. Yes, it works. We've taken decisions without any impact on financial stability and on the taxpayers' money. So it works, but it can be made working even better. Thank you very much.
Thank you, Dominique. That was fantastic. Kate.
Yeah, so that did a remarkable job summing up so many different dimensions of resolution in an incredibly short period of time. I think I'm going to try and draw out just a couple of those themes. So first, as a starting point, as you noted, the US has a much longer experience with this, with the FDIC, but historically the FDIC only had resolution authority over the insured depository institution. So just the bank, then it's expanded to thrifts. And really what the universal lesson was from the period of 2008 is that is far too narrow if what we're really worried about is trying to create a credible resolution authority for financial institutions that could pose a potential threat to stability. So that meant both, we had to look beyond the bank in the United States to really look at the bank holding company, but we also had to start to look, as you noted, at non-bank financial institutions. And of course, a key challenge in the EU and in the United States, so it plays out differently in the two different jurisdictions, is not only how you get enough liquidity when the time really comes, but also how you create a liquidity mechanism that is going to be credible enough that market participants really trust it, given the incredible uncertainty and the fact that it is almost always easier and safer to walk away than to stick around in the face of any uncertainty. And so as you noted, there's two different challenges. One is the capitalization piece and the other is the liquidity piece. And in both the United States and the EU, and in different ways, there have been different ways of putting in loss absorbing capacity that, at least on paper, should be able to absorb the losses that might be incurred under the circumstances of requiring a resolution. But that's very different than having the liquidity and the calm that you need to make the resolution plan work. And the United States, just as a recollection for folks, we made this more complicated because we decided to require banks to put together a living will, which is our term for their resolution plan, that in theory doesn't require government liquidity. So the resolution planning, the affirmative planning that banks have to engage in, and that has to be reviewed and supported by the authorities, and where there is meaningful progress right now underway with respect to the regional banks, because that really has been a significant shortcoming, is in theory all done under bankruptcy. But of course, there's a lot of reasons to question regardless of how sound a plan looks on paper, whether it will actually work. And so then we have this fallback alternative of what we call Title II, because thanks to Title II of the Dodd-Frank Act is the statutory place that gives the authority that allows the Treasury Department, the Fed, and the FDIC to work together for a resolution process that is still managed by the FDIC, but where there is liquidity provided by the Treasury. And the idea is that under this circumstance, the government backstop, coupled with the loss absorbing capacity and the other tools put into place, capital put into place, might in theory provide the calm that is needed. But of course, I think there was appropriate humility in the United States and in other jurisdictions. It's always hard to know how these things are going to play out. And so I really appreciated your comments today and the other comments you've made recently on that core challenge of like, what do you do with funding in the moment? Where are we going to get the liquidity, and how do we actually think about those dynamics? So I think that is one of the keys, even to your point at the end, between difference of what works on paper and what works when the time actually comes. Two other quick notes that just to pull out on some of the themes. Another core challenge, which I think is just a constant challenge, but is always worth paying attention to, is the cooperation with cross-border interconnections. And it is just going to be an incredibly chronic challenge. And it's not unique to financial institutions. I mean, I talk to my colleagues who are bankruptcy specialists, and actually the tendency towards territorialism, when everybody would be better off with a universal regime, is chronic in resolution generally. It's just far more pressing when we're talking about the resolution of financial institutions, because the speed at which developments are occurring can result in incredible losses and adverse collateral consequences if you're not able to coordinate in a timely way. So I love the attention to that, but I do think it remains kind of a constant source of challenge, no matter how well everyone's trying to plan in advance. Two final notes. I appreciated the comments about the spring. And when you're talking about the lessons from the spring turmoil, I noticed what the primary focus was on how quickly confidence can be lost, which is long been true for financial institutions, but was visible in a very different way with Silicon Valley Bank and even Signature. But of course, Credit Suisse in some ways was almost the opposite. I mean, it was an institution that was like the ultimate slow burn, where there had been fundamental questions about its ongoing viability for a good year prior to its ultimate failure. So you're right, the demise was in some ways quick at the very end, but there was also an incredible buildup. And so I was just wondering if you wanted to say more, could say more about what that tells you about the need for close coordination, as you're already doing, with bank supervisors. Because again, part of the question over any resolution plan actually being viable is the timing. And it's an act that is an incredible act to undertake, because you're fundamentally changing the rights of a whole variety of different stakeholders, and you're going down a course of action that of course has significant other reverberations. But the timing matters a lot. So I was wondering if you want to talk a little bit in both like the speed, but also the slow burn about coordination with supervisory authority, particularly given the unique architecture of the EU. And the last thing I'll say is just the non-bank financial institution is an even bigger problem, probably in the US, and it remains a real challenge. And in theory, the way we tried to deal with it was to allow this Title II authority, which is the mechanism that we have for resolving non-bank financial institutions, to apply not just to bank holding companies, but potentially any non-bank financial institution. But you're only going to be able to do that in a orderly way if you have some plan. And we'd had this idea in advance that we were going to designate non-bank financial institutions systemically significant as a way of forcing them to not only have more robust ex-ante regulation, to be subject to oversight to the Fed, by the Fed, but also to have to engage in meaningful resolution planning. And we did this for a while, and we saw AIG and MetLife, GE Capital, and other institutions designated. But of course, we right now don't have any institution designated. The Treasury Department has issued proposed guidance that would help to revitalize the designation authority, but it does create a challenge in the interim where the FDIC in theory is having to prepare for the possibility of acting as a receiver, but for entities that are really not subject to federal prudential oversight in the ways that banks are. So it's a different, but also I'd say still pressing challenge across jurisdictions. But thank you.
So just for clarification, Kate, on this last point, the Federal Stability Oversight Council, FSOC, is supposed to designate non-banks that are systemic in nature and deserve that oversight and can go into Title II if they fail. But at this point, that list is empty, right? Because some insurers were there, but then they sued and they won, and they've been removed from the list.
Yeah, and that is exactly it. And they were never in a statutory scheme required to be a synonymous set. But I think there was some implicit understanding that we would use designation authority. And so the Financial Stability Oversight Council was another Dodd-Frank creation. Rather than creating a new systemic stability overseer, the idea is let's bring this panoply of financial regulators that we have in the United States. And it really is a messy scheme in the United States. So we have 15 members, 10 voting members of the Financial Stability Oversight Council, Treasury in the leadership position, all three of the banking regulators, the two market regulators, and other specialized regulators there as well. We have the additional oddity in the United States that insurance is not regulated at the federal level at all. It is instead regulated at the state level for the most part, creating an additional level of challenge with respect to making sure that the ex-ante oversight matches the potential threat. So there is work underway at the Treasury Department through FSOC, but it's certainly been a challenging process.
We used to have jokes in the European Union about all these different federal authorities in the US, but now we can no longer make those jokes because we're creating new EU authorities all the time. And I actually think it's a good thing, but it limits our ability to make fun of the Americans. Dominique, I want to come back to one thing you said at the end, that the system works because in all the decisions you made, there was no need for taxpayers' money. That's a bit of a shortcut, isn't it? Because you made, in the way the system works in the EU, you have to determine if a failing institution is of public interest or not. So there's this very important, very difficult to comprehend test, the public interest test. And as you rightly said, in all the cases, there have been only 3 of them that I know of, in which you have found a public interest, there was no use of taxpayers' money. That was Banco Popular Español in 2017, and then the 2 small subsidiaries of Sberbank Europe last year at the beginning of the invasion of Ukraine by Russia. But there have been a bunch of other cases where you had a negative public interest assessment, and there's a notorious one of the 2 banks in the Veneto region of Italy in which you made that assessment also in 2017. And here there's been a lot of use of taxpayers' money in those cases. So can we say the system works when actually a lot of, it seems there are many holes in the framework?
Well, indeed, we can discuss longly these 2 cases you mentioned. By the way, the list is not so long about the cases in which there was this use of public money in liquidation and a sort of, let's say, a different judgment between the resolution authorities and the member states in charge of supporting the liquidation process. But this is exactly the topic that CMDI, the proposal made by the Commission, wants to address. That's to say, okay, let's consider that instead of letting the bank fall outside of resolution, let's consider that the resolution can bring a better outcome than liquidation without liquidation aid, obviously. So the idea is to say that indeed, resolution can provide for financial stability in a better way than a normal insolvency procedure for a bank. For it's a very simple and very easily understood reason is that when we enter into the process of resolution, we implement our decision immediately after the weekend, if it's a weekend. And the day after, the branches are open, the ATMs are open, and the customers can access their accounts. While in liquidation / national insolvency, the bank is closed and the liquidator is connected with the DGS to organize the payout of the covered part of the deposits within 7 days. So during at a minimum 7 days, there is a possibility of disruption compared to resolution. This is one of the key differences, and this is why the Commission wants to expand the scope. As I said, we can discuss longly about the systemicness at regional level. We have definitions of regions which can be different, and as we've seen in the US, all these Californian banks were not considered as systemic, regionally speaking. And at the
I'm
end,
not sure my connection works well, but let me just come back to this. And by the way, I see Alain Laurin in the audience is raising his hands, but actually, Alain, you have to ask a question through the Q&A tool, and this is true for all participants in the audience on Zoom. Please don't hesitate to use the Q&A tool and ask questions, and I will take them on board for our two speakers. But Dominique, on this question of the regional banks and kind of the threshold for this public interest assessment, and same for Irina Lichodowska, if you can use the Q&A tool, please, and please don't raise your hands because I cannot give you the microphone with the current settings of the platform. So you mentioned the CMDI legislative proposal. Again, that's for crisis management and deposit insurance, but it doesn't create a European deposit insurance. It just tries to make the national deposit insurance work better with crisis management. Does that proposal set a threshold? I mean, in the US, there was this debate about thresholds for regional banks. Is that $100 billion in total assets? Is that 250? Will we have a threshold in the EU for that?
No, we can't. We can't because in the banking union, made again of 21 countries, the banking systems are completely different. And the thresholds of systemicness are completely different from one country to the other. Look at the decisions we've taken. You've mentioned 3 of them. So one was about Banco Popular, 160 billion euros of total balance sheet at the moment of its failure in 2017. The 2 others were very small compared to this case, very small entities, subsidiaries of Sberbank in Croatia and Slovenia. But at the same time, they were systemic enough at national level in Slovenia and Croatia to justify our intervention for selling them to somebody else. So it's not a question of threshold. It's a question of critical functions impact at national level for the moment and perhaps tomorrow at regional level. What I would like to say, because it is part of the debate around CMDI, is that the idea is not to consider that all the banks should be considered as systemic and should fall into resolution instead of liquidation. For a very simple reason, is you cannot become a bank earmarked for resolution from day 1 to day 2. You need to become resolvable. Sorry for this jargon again, but it means building loss absorbing capacity, building separability, building errata systems, etc.
Let me again challenge you on this. There's a country in the European Union which is subject to the exact same legislation, the Bank Recovery and Resolution Directive, BRRD, and the future CMDI if it gets adopted. And that country is Denmark. And the practice of the Danish authorities, again under the exact same legislative framework, but outside of the Eurozone, has been to have a positive assessment of public interest for all banks that fail, no matter how small. They've been placing some very tiny banks into resolution. So they seem they have a completely different legal analysis from yours. Can you explain the difference between your doctrine and the Danish doctrine?
Well, they start from the idea that every bank is systemic enough to be considered to be earmarked for resolution, and they ask all the banks to be ready for their potential crisis. That's to say, asking all the banks to have sufficient loss absorbing capacity, to have this separability, etc., etc. I don't know about Denmark, but they are in charge of, let's say, something like 150 banking groups, something like that, perhaps less. I don't know, frankly. Yeah? We are in charge of more than 2,500 banks, including all the smallest ones, members of IPSEs, etc., etc.
What you're implying.
Sorry. Let me finish, Nicolas. So it's just not reasonable. It's just not reasonable
So
sorry, let me finish, please.
Sorry.
It's not reasonable to consider that all these 2,500 banks are delivering critical functions to our banking union citizens. It's not reasonable because it would be extremely costly for the banking system to build its resilience. And in reality, we have seen a number of liquidation decisions during the last years without any impact in terms of financial stability. So this is my answer to the Danish approach.
So, just to understand, and I'll ask Kate about her opinion on that, but what you're describing here is a difference of capacity, not of legal status, right? What you're saying is it would be impractical for the SRB to view all banks are, as you said, earmarked for resolution because it's just impossible to manage for your organization. But it's not a matter of the criteria as they apply to the banks, or did I get that wrong?
No, I know that you like to challenge people, so you misunderstood me here. It's not a question of my capacity or the capacity of my organization. It's a question of the capacity of the banking system itself. Perhaps it's doable at local level for, let's say, a member state like Denmark, but it's not doable at the size of the European banking union system. So the problem is that again and again, the misalignment is about the impact of the failure of a very small bank. We still consider that there is no impact when a very small bank fails, and it should be able to fail without going to extraordinary powers which are under the resolution framework. Denmark considers that it should be the case for all banks. Well, I think we cannot support this approach.
Here, Kate?
Jump in, because there's both like what the standard is and then there's what the process is. And this is where it's so hard. I mean, Dominique mentioned early on that there's this incredible challenge between predictability and flexibility. And this is exactly where the US keeps getting into trouble. So we've long had the systemic risk exception built into the regime. As soon as we put in the least cost resolution requirement on the FDIC, which was a byproduct of the SNL crisis, we said, okay, we want them to resolve in a way that does not involve a lot of cost, but we recognize there's going to be some circumstances where there could be collateral consequences to the health of the financial system that would justify deviations. So originally that was just housed in the FDIC and it could be used relatively flexibly. And then we said, no. We thought that got used in overly broad set of circumstances in connection with the last financial crisis. So the Congress thought that they were really going to tie the FDIC's hands. And they said the way we're really going to tie your hands and make sure that it's only in extreme circumstances is we know it's hard to define what this is ahead of time. So we're going to create a high procedural hurdle. You need a super majority of the Board of Governors. You need the Treasury Secretary in consultation with the President and a super majority of the FDIC. Well, and then that's really going to limit it. But then you still ended up with a circumstance where you had banking institutions that I think a couple weeks earlier, very few of the people who voted for the SRE would have identified them ex ante as systemically important. They seem sufficiently idiosyncratic that those the collateral consequences seem like they should have been able to be contained, but suddenly in the moment there was uncertainty and there was this real concern of if we allow these institutions to go down, what message are we sending to depositors in other institutions that we can distinguish, but that we might not be able to distinguish under this high pressure situation in a way that's fully credible to the depositors of those other institutions. And it created a real challenge. And I think you framed the challenge up nicely, but at least in the United States, but I think more generally, it's very hard to have a time consistent policy. And really, it's really the process as much as a legal standard that you're having to look at, because this is happening in real time and you're not going to have kind of a lot of law that's developed. So it is the rigor of the process. And I think that, going back to and supporting Dominique's point, could create a meaningful distinction between how this plays out. So it's not just that you have a different default in Denmark and at the EU, but procedural hurdles can in practice make the same legal standard implemented in a very different way and used less frequently. Which is really oftentimes what we end up doing with bank regulation and resolution.
There are two questions which hint at not only procedural differences, but also political issues. And I'd like to have your views on this from both speakers. Alain Laurin is observing that, in his opinion, CMBI's as proposals that is being examined doesn't really address the core issue, which is that member states actually want to have the ability to resort to taxpayers' money in case of bank failures if they deem it necessary, and therefore are in contradiction with the objectives of the Bank Recovery and Resolution Directive, the resolution framework as it exists, as you mentioned, Dominique, which is to minimize the use of taxpayers' money. And Pentti Hakkarainen is asking whether the SRB should not be empowered to take care of deposit insurance for the entire banking union, which is basically the proposal of a European deposit insurance scheme. So I guess both questions hint at this question, at this issue of keeping a large role for national authorities, both in terms of potential providers of state aid in the handling of banking crisis and as managers of deposit insurance, which the current proposal of the European Commission don't really change. Can we have a functioning system, Dominique, as long as we have this heavy involvement of national authorities? And also an important question, even so I think I know your position on this, are you in favor of a European deposit insurance?
So all in all, at the end of this, beyond these questions, the key question is, do we trust the mechanisms we've put in place, and do we trust the authorities in charge of that? If we were trusting the mechanisms and the authorities, normally speaking, we would not need to keep an eye open on the possibilities to intervene. And it's very clear that that's true, that for the moment the European member states are not completely persuaded, despite the progress made, that the mechanisms in place are working well. This is in particular the question of the untested bail-in tool, and that's true. I say that in front of you, that from time to time I have the feeling that the level of trust in the authorities implemented in the banking union, and in particular on the resolution crisis management side, is not as high as I would like it to be. So it's for me to demonstrate, I cannot ask people to trust me, it's for me to demonstrate that we are trustful, and we have a framework which is implementable and which can be trusted also either. So indeed, that's true that at the very end, member states, governments, ministries of finance would like to keep an eye, and this is exactly what is not anymore possible in the framework they adopted. I'm not a legislator, I'm in charge of implementing the framework. And what I tell them is that the best thing to do is to discuss ex ante. And coming back to Kate's remark about cooperation between authorities, let me reiterate once more that cooperation and aligned communications are key for building trust, not between us, the authorities, but trust in the markets. And this is the only way of tackling the expectations. I'm used to say that there's a virtuous circle and a vicious circle. The virtuous circle is to build trust, and the more trust we have, the less barriers we need inside the banking union. The more lack of trust we have into the framework and into the institutions, the more need for barriers and keeping the capacity of acting at national level we need. On the second question, yes, indeed, very clearly EDIS is needed, because indeed it will give an additional layer of confidence in the system, and by giving confidence, we increase the financial stability. We have seen a lot of stickiness in our depositors' basis during the last crisis in March. It's not a given that in the future this stickiness will stay. So we need to build additional layers of confidence, and EDIS, this common system, a European deposit insurance scheme, managed, if possible, by the SRB, the Single Resolution Board, or by whoever you want, but it could be by the Single Resolution Board like the FDIC, could be a solution to increase this confidence in the system.
Before I want to hear Kathryn on this, and I'm also aware there are many questions, and we won't probably have time to address them all. But I'm struck by, in a way, the candor in which you mentioned this issue of the way other authorities and the member states view the Single Resolution Board, and that obviously has been linked with past decisions of the board that were controversial, especially in declaring, as we mentioned, that some banks were not of public interest, which subsequently received state aid. Is it the case that the doctrine, not talking about individuals here, of course, and you've been on the board from the start and now are leading it, but is it the case that the doctrine has changed? Do you see a difference in the kind of framework of decision-making that the Single Resolution Board had back in 2017, say, and what it has now in terms of particularly this question of the public interest assessment? There have been many internal debates within the board, I'm sure. Can you give us a sense of that?
Well, there are two completely different things. Let me start by the other one, the one you did not mention. Indeed, we take note of some criticisms coming from generally speaking, a lack of understanding of what we are doing, a lack of transparency from our side. So this is covered by the strategic review I've launched when I arrived, saying, okay, we've built the first step. Perhaps there were good reasons at that time to process the building of resilience by asking loss absorbing capacity, etc., without too much explanations. But now we are starting another phase where we need to be understood. So we need to be more transparent. We need to consult. We need to let sufficient time to the industry to react. And this is exactly what we want to do in the coming months and years. On the question of the implementation of the framework itself, there is a change through years, which is the progressive expansion of the elements which were mentioned in the legislation, but which were not analyzed during the very first years of the story of the single resolution mechanism with the same attention, which is the potential connection between the crisis of one bank and its systemic implication for the others, or the systemic crisis and its implication for one given bank. So this interaction between something which could be systemic and something which could be idiosyncratic. And based on that, that's true that we have progressively expanded the number of banks earmarked for resolution based on a broader analysis of the public interest assessment.
SRB, your predecessor as SRB's chair, Elke Koenig, in the early years, especially, often said that resolution is for the few, not the many. This is not the current attitude that you just summarized, correct?
Well, we can discuss longly about this historical sentence. Let me give you figures. It's as simple as that. Let me give you the figures. So we have 10-ish, it depends, well, one more, one less, significant institutions under our direct remit. That's to say significant banking groups, so the biggest ones. So out of these 110, we have 90-ish, which are targeted for a resolution. So that means, again, that there are 20 others which are targeted, earmarked for liquidation. I can give you an example. Development banks, they are public owned. They are building a very specific business model with a lot of public involvement. They are not good candidates from our point of view for a resolution decision. Right. So outside of that, we have, as I said, an indirect scrutiny on, let's say, 2,500 other banks or 2,400 other banks. Out of these banks, there are today around, let's say, 70 banks which are earmarked for resolution, all the rest for liquidation. So the sentence you've mentioned is still true when you compare the number of banks earmarked for resolution and the number of banks earmarked for liquidation. When you look at let's say the size of these banks, taking into account their assets and liabilities, etc., in reality, we are covering the vast majority of the banking union system by resolution plans.
Right. Sorry, back to you, and back to the questions that were asked by Alain and Penty. This fundamental question of, can you really make the system work when you have this multiplicity of centers of decision? How do you look at that viewed from the US?
Yeah, I mean, I think it is a fundamental challenge. It is a greater challenge, I think, in the EU than in most other jurisdictions because of the differences between where authority lies for the SRB relative to the national authorities. But I think Dominique actually hit on the other key challenge, which is prior to March, I would have thought that Pillar 3, the deposit insurance, was the critical piece. And now you really need to put that in place. And once you put into that place, that really helps the overall regime seem more viable. That's a real question for me now. And I think it's a question a lot in the United States is like, how do we actually create deposits that are sticky when we need them to be sticky? And we long thought deposit insurance was the mechanism through which we did this. But of course, what we realized is you have a lot of uninsured deposits. And I think even under the various proposals for ways of looking at what you would do in the EU, the same would be true. The United States has the additional challenge that we have money market mutual funds as a very viable and more robust alternative. And so another way you can make deposits more sticky is just by reducing the attractiveness of the exit option. All that being said, I think in an era of digitalized finance and where depositors are far more informationally savvy, it's working so far that you can hold on to depositors by just paying them more. So you're like compressing that interest margin for the sake of getting more sticky deposits. But I think that really remains a very significant challenge that nobody's fully managed to grapple with in the new era in which we're now living.
We've got plenty of great questions in the Q&A, and obviously it's too late to answer them all, and this is just my failure as a moderator. We'll probably, if you allow me, Dominique, try to invite you in the future for another session to cover many of the other topics. There are great questions about liquidity in resolutions. There are questions about transparency. I just want to take one as a final question, and maybe to you, Dominique, from Maria Anna Barata, on this dichotomy, which we've already spent a lot of time on, but is really fundamental in the EU regime, between resolution and liquidation, which is often puzzling to people from outside of the EU, because for them, liquidation is part of, it can be even synonymous with resolution. So as Mariana mentioned, in the key attributes for effective resolution regimes of the Financial Stability Board, which are kind of the global standard for these things, this states that being able to initiate the liquidation of a bank is a resolution tool. So why does the EU keep liquidation outside of the resolution toolkit? Is it due to national differences in participating countries? What justifies this whole construct, which you have explained very clearly to us?
Well, I'm not sure that we can say that liquidation is completely outside the framework. In reality, by essence, when we are asked to consider that a bank is failing or likely to fail, so the decision is for us. It's for us to take this very complex decision. Then once we've said yes, we have to decide either to go for resolution or to let the bank go to liquidation. Let me say that not to decide to go for resolution is also a decision. That's to say, we are obliged to justify ourselves. And if you look at the published decisions about the decisions we've taken for letting the bank go to liquidation, we have explained via pages and pages why we've considered that the outcome of the failure would be better managed under a normal liquidation process than under a resolution one. Coming back to the Danish issue you've mentioned several times, there's a key difference. We are not judges. We are not courts. We are implementing extremely strong decisions. We don't ask the General Assembly to decide. We take the money. We sell the bank without, etc., etc. So these are extraordinary powers. And to some extent, If we say that banks are still normal corporate firms, to some extent, it's not unreasonable to consider that liquidation should be a potential outcome if we have demonstrated that their failure under a normal insolvency procedure would not create financial instability. It will create losses. If we decide to intervene, there will be a price to pay. If we decide not to intervene, there will be a price to pay. A failure is still a failure. It's costly. And this is a big mistake made by a number of stakeholders to think that the resolution powers give us the extraordinary magic wand, which can make a resolution not costly. It will be costly, obviously. The idea is to try to find something preserving financial stability and not detrimental to the creditors. Don't forget the no creditor worse off principle, which is extremely crucial and which is mentioned in the key attributes of the FSB, by the way.
Fortunately, we have to cut it there because we're already past time, but many thanks for very clear pronouncements and by Dominique Laboureix and Kathryn Judge on this very complex but very interesting issue of resolution of banks in Europe. My apologies to a number of participants, Victor Sebek, Patrick Kenadjian, Marc Dobler, Tom Huertas, and others who asked excellent questions, which I didn't have time to bring on. Our next session will be on November 8th, in 2 weeks' time, with Alexandra Prokopenko. We will discuss the Russian financial situation after more than a year and a half of war, including the financial position of the government, but also the banking sector. And in the meantime, I want to again extend my very warm thanks to Kathryn Judge and Dominique Laboureix for an extremely illuminating session. Thank you so much.
Thank you. Thank you very much for your time. Thank you. Bye-bye.